In today's featured conversation, Logan, Mohtashami, and I discuss recessionary concerns for the U.S. economy, the latest housing market data, and economic outlooks for homeowners. If you're not familiar with his work, Logan is a housing data analyst and financial writer whose work is frequently featured on Bankrate.com and Bloomberg Financial. Logan is a lead analyst for HousingWire and has spoken at AmeriCatalyst, the California Association of Realtors, and other economic conferences. This was a great conversation, and I hope you'll enjoy it as much as I did. Logan Mohtashami is the lead analyst at HousingWire. You can find more of his writing at HousingWire.com. And of course, hear him regularly on HousingWire's suite of podcasts. Plus, you can listen to a more in-depth conversation from earlier this year on our Founders podcast, Batting 1,000 with Dale Vermillion. Logan, before we get into the fifth recession red flag you just recently raised, let me just ask you flat out. Are we in a recession?
No. Technically, we've never had a U.S. recession where industrial production, real sales, and employment are all rising. And that's kind of the data that we've had, from January to now. Data lines are getting weaker, though. That's for sure. But if it seems like the Federal Reserve isn't like panicking about the economic data yet, it's because we're not technically in a recession. If you look at the history of economics, usually real sales, industrial production, and employment are all falling negative kind of together. It's not the case. Employment is still, we're still producing jobs. Production is still going. Retail sales, even consumptions are still positive. So we are at a later stage of the economic expansion, of course, and some of the data lines have gotten weaker. But technically, a recession isn't 2 quarters of negative GDP. It's really kind of 2 quarters of economic decline in total activity. And I think people are confused about that because they saw the negative GDP in the first quarter, and then second quarter, it's a toss-up if we're positive 3% or down slightly. So we're not technically or legally in a recession currently.
All right, so we're not technically in a recession, but you did recently raise your fifth recession flag, which you talked about in detail on the Housing Wire Daily podcast a few days ago. You've written about it as well. For anyone who may have missed that conversation or your recent articles on this, what flag did you just raise and why?
So my first primary work is working on economic expansions and recession cycles. That's kind of the big reason I do everything. Now, if you look at the history of U.S. economics, there's a certain group of data lines or events that happen before a recession. I call it the 6 recession red flag model. The first one is unemployment rates get to a certain percentage for me. The second one was the Fed starts its Fed rate hike process. It's a more mature expansion at that point. Number 3, the inverted yield curve, which is more of a marketing a timing event. I was on inverted yield curve watch since November of last year. We got that. That's checked off. And then you want to look at where's the big overinvestment or booming demand sector in each economic expansion. We see that in durable goods spending, retail sales, all these stay-at-home companies that had a massive boom because we purchased their goods. And I always use the Peloton effect as a form of talking about a job recession and a company leaving, firing people. Peloton had booming demand. Demand couldn't be sustained. Inventory buildup. They had to let people go. You try to kind of want to keep it simple as that with the fourth recession red flag. Now, the last 2 are always the most important ones. 5 and 6, and I'll go back to the housing bubble years, not the COVID-19 recession. That was very brief. 2006, the last 2 recession red flags were raised for me back then. So I was on the 6th recession red flag model going. The recession didn't happen until toward the end of 2008. Here, the 5th recession red flag is housing starts and new home sales typically fall into a recession. The builder's confidence index has been declining. Today, we had a very surprising new home sales report, but you could kind of see that the builders are kind of going to slow things back down with mortgage rates rising. That traditionally happens going into every recession. It's not going to be the 2005 build-up 82% crash in new home sales, massive supply situation, but you can see a pausing of what the builders do. And then the 6th recession red flag is the leading economic index, is a set of 10 data lines. Traditionally, before every single recession, these data lines move down 4 to 6 months. So we've had 1 or 2 months of decline, nothing very big in nature, but you can kind of see the economy slowing down. And partly the Federal Reserve kind of wants that to kind of make sure that the rate of growth of inflation falls. So we're at that stage. It's much different than, of course, COVID wasn't an economic recession. That was a health crisis. The housing bubble years was a credit bubble that needed deleveraging. We don't really have that. We have excesses in a few sectors of the economy. Of course, crypto has fallen out. Durable goods spending will come back down to normal. So there isn't that type of dynamic of leverage. But leading economic index traditionally always falls. And the data lines that are the components of that are starting to get weaker. So once the sixth recession red flag is raised, then I'm on recession watch. It's not actually a recession. We're on technically a recession watch then, because it's a progression model. I'm not here to glory hound on recession calls or stuff like that. We want to show people what the history of economics is. And these are the things that traditionally happen. This way you take all the noise out of the kind of the boom and bust crowd of the internet, and we bring it back to very boring economics, right? Because economics done right should be very boring. It's not really designed to be this really exciting thing. And I think people lose perspective of that. But again, the fifth recession red flag was raised. The builders' confidence have fallen down. Housing permits and starts are slowing down. So we'll deal with the sixth recession red flag next. But as of now, again, the economy is slowing, not in a recession. The Federal Reserve is hiking. They're very aggressive. So you kind of do the math of previous expansions. That's how recessions typically occur. So we just need to keep an eye on the last few data lines left.
So talking a little bit about builder confidence dwindling, in contrast to some other analysts that I've heard, you believe that while housing inventory is obviously low, historically low, and that it is rising, we should note, you argue that we're not underbuilt. Can you explain that and why that matters?
Well, the builders only build off of their demand curve. And what I mean by their demand curve, they only care about selling new homes. So total inventory in America actually collapsed to kind of all-time lows in 2020. So the timing of it was the worst possible ever because we have the biggest housing demographic patch ever, mortgage rates are low. So home prices has accelerated. In the previous expansion, the builders had the weakest new home sales cycle ever. They missed sales in 2013, 14, and 15, and then in 2018 they had a supply shock. So when people say the builders didn't build enough, that's actually not true if you look at them as their business model. So they just build slow and steady, and they just try to make as much money as they can. The existing home sales market is actually their competition. So if you look at it in that light, existing inventory is increasing, working from all-time lows. So we're not even back to either 2012, 2014, 2016, or even 2018 levels. So we have a way to get back, getting listings back up to there. But the builders look at it differently. They say, wow, well, those homes, there are a lot of them and they're cheaper than ours. So we have to be a little bit more careful now that mortgage rates gone from 3% to 6%. And you can see their confidence is dwindling. Cancellations haven't picked up too much yet, but they're just a little bit mindful. But I always stress to people, new home sales is still historically very low, actually. It's below the 2000 recession. So there isn't a booming 2002 to 2005 market. So we have to treat it that way, that when you have a very low new home sales, there isn't kind of like this boom or bust cycle that can happen, and more of a grind. And the builders are managing their construction. Of course, we all know housing construction has been delayed because completions can't get done on a timely basis. So the builders actually have like months of supply that is just kind of either under construction or they haven't started yet. So it's unlike the previous expansion where housing starts, new home sales, credit, prices, completions all move together. So the builders are just taking a step back, and they're just going to make sure that they don't have too much inventory where they cut down on their margins too much, because it's a business and they don't look at it as this is not like the March of Dimes where they just get funded. They only get funded by the product they sell. So that's why the confidence has fallen down so much. They just want to make sure they don't build too many homes and get themselves in a situation where they have to cut prices so much.
So starts will reflect the demand, which is dwindling at the moment, is what you're arguing. What's going to happen to completions, or what is happening to completions at the moment?
Now, completions are picking up because they lag, which is it's a weird phenomenon. Housing starts and permits are actually going to go below completion soon, just because we're just finishing up all these homes that were in the process. So that part will catch up, but the permits are slowing down and the starts are slowing down. And with 6% plus mortgage rates, you can understand why the builders are a little bit more mindful of everything now. Life is good for the builders when their monthly supply is under 4.3 months because they could sell the products. Things are moving fast. They're okay. They build out. Here, the mortgage rates just shot up very fast on them. So they're a little bit more mindful, and that's why their confidence is falling down. So we'll see what happens if rates come back down within this year or next year. So we'll deal with that process then. But right now, it makes total sense why the builders would be pausing on future plans of construction until they get all these products that they're finishing up sold and off the books.
Sure. So we're not in a recession now, but 5 of the 6 recessionary flags have been raised, and that doesn't necessitate a recession, but it puts you on recession watch, as you said. I've heard you argue that recessions tend to impact non-high school graduates mostly, so renter profile, right? Not a homeowner profile. And you backed it up by referencing unemployment data for home owning college graduates. Can you share your thoughts on how, if we were to officially enter a recession, that would actually impact the housing market, both from an origination and servicing perspective?
So rates traditionally fall. And because we have a supply of loans that are above 4.5, 5, and now 6% mortgage rates, what will happen is you'll get kind of another refinance, not like a mega wave, but you'll have some people that can be able to refinance that. That's just following every traditional economic expansion and recession. What will happen is the homeowners on paper look really good, right? And when you look at the unemployment rates, the highest unemployment rates come from those that are tied to renter financial profile. So typically, the renter will lose their job, and then either the investor or the landlord gets hit on that side. How much they can handle? Can they find somebody right away to replace that? You have to look at it in this context. Majority of Americans are always working, right? And rental vacancies and home vacancies are really low. So the rental side is more prone to stress, and we saw that during even COVID. Forbearance has collapsed. We're almost completely out of that program altogether. But in a job loss recession tied to consumers, the tech industry, of course, can get hit right now. You see a lot of their stocks get crushed. But that's where you would see the stress in the marketplace going out. Again, you're always going to have what we call late cycle lending in housing, where the last home borrower bought right before a recession, low down payment. If he loses a job, doesn't have a lot of selling equity. That's a traditional housing risk. But in scale terms, when you have 11.5 million job openings, this is not the 2008 job market where, job openings were at 2 million. Our aging demographics actually give us the need for labor. And what that means is, like I've always talked about, there is no Dorian Gray labor market. Everyone ages and they die off. That's just the way humans work, right? So the baby boomers are leaving the workforce. They need to be replaced. And then on top of that replacement worker, if demand is growing, we need more. And that's part of the reasons why job openings have been rising really since the lows in 2009 all the way here. So the labor market is going to have much more dynamics. Think of kind of like the recession in 2000, where, in that environment, inventory actually fell, rates fell, there was a refinance, housing demand stabilized, rates went lower, kind of something to that nature. You don't have the credit leverage bubble on homeowners. I know a lot of people talk about investors, that's a whole different segment out there, real estate investors compared to traditional homeowners. So the homeowner, again, is going to be in a very good spot in that regards. But when rates fall, you should see a pickup in refinancing because the supply of loans that have higher rates are picking up every month with the new purchases. The question is, how low do rates actually go? If you look at the last 4 decades, mortgage rates have fallen 2% plus from the lows of each cycle. That's going to be pretty much impossible now because rates got to 2.5%. We're talking about like a quarter mortgage rate. But getting back to the four, something in that nature. My concern is actually whatever inventory we have increased, some of that gets taken away, and then we're stuck in this kind of still historically low inventory level. And everyone sees what's happening with home prices. People had anticipated home prices to be falling this year. Guess what? We're still at double digits. The last existing home sales market is running at near 15%. The Case-Shiller index, which lags, is running at 20%. So people are confused, but that's why you have to focus on the total inventory data and why we have to get back to 2018-19 levels just to be back to normal. We're not quite there yet. That's something that can possibly happen next year. But again, when you're working from these lows, it's savagely unhealthy because, again, you have the forced bidding of homes. And that's starting to go away, which I think is a positive. But we have a lot of work to do just to get back to the pre-COVID era. And then that is a normal, balanced housing market. Using the NAR data is about 1.52 million to 1.93 million monthly supplies over 4 months. That would be a traditionally normal market. We're a little bit under 1.2 million currently right now, 2.6 months of supply. So we're working our way back up there, but we're not quite there yet.
So just to hit it again, because you've touched on rates potentially coming back down to the fours, home prices continuing to remain fairly unhealthy because we may or may not actually see growth in the inventory over the course of this year. As you look out at the horizon, where do you see rates and home prices especially ending up at the end of this year?
Well, we're kind of halfway into the year. So traditionally, when home prices decline, you see growth rates really falling, and then the decline actually would happen in the following year. We're obviously not anywhere close there. When you look at the weekly data from Redfin and Realtor.com up until June 19th, you're still seeing median sales prices and listings 14, 15, 16%. Rates in itself, what I believe has happened is that the 10-year yield and the mortgage rates have gotten well ahead of the Fed, and people are now doubting that the Fed will actually get to their target levels of rate hikes. When the economy really starts to weaken, they'll change their tune. But right now, their full focus is on fighting inflation. And we had inflation last year, and mortgage rates and bond markets didn't really take off. It was kind of after that Russian invasion of Ukraine, and the Fed was pivoting, that bond yields and mortgage rates got well ahead of the Fed. And for anybody that wants to look, there's a big difference between what's happening now than, let's say, in 2018, when the Fed was raising rates slowly, the bond market went up, mortgage rates went up. Mortgage rates and bond market went ahead of there. And now it's this tug of war. This is this theme for this year. Can the economy stay firm enough for the Fed to do all the rate hikes they want, or are they going to cry uncle? Majority of the people are saying they're going to cry uncle in reverse, and we're already seeing future prices of rate cuts happening in 2013 or 2023 and 2024. And even the Fed members have talked about that as well. So we're just in this very unique situation where the economy is slowing down, but the Fed is fully focused on trying to bring down inflation. So they're kind of, for now, ignoring that, where traditionally that would have been the case. They would have stopped their rate hikes at this point. But that's not their main concern is price stability, because the labor market is still creating jobs. They're focusing 100% on that.
Logan Mohtashami is the lead analyst at HousingWire. You can find more of his writing at HousingWire.com. And of course, hear him regularly on HousingWire's suite of podcasts. Plus, you can listen to a more in-depth conversation from earlier this year on our Founders podcast, Batting 1,000 with Dale Vermillion. Logan, thanks so much for sharing your thoughts. Keep up the great work and come chat with us again soon.
My pleasure. Thank you.